Today is much more than Halloween, and it is a day that may be more influential to many key stocks than Wednesday's rate cut at the Federal Reserve. Today is the end of the fiscal year for mutual funds. For a look at how the year went, joining me now is John Koumanaros. He's a Morningstar stock analyst, and Ramesh Menon is the founder and president of Structured Investment Management. Good morning, gentlemen. Thanks for being here.
Good morning.
Ramesh,
Good morning.
Let me start with you. This has looked like, if you were to tally it up by the end of the day, a very bloody year for the mutual funds. What is it, as we wrap up to the end of the day here, on average, what have you seen?
Well, yes, this has been a very ugly year for mutual funds. I think it bears out the fundamental fact that equities do have a tremendous amount of risk associated with them. The market has not typically taken that into consideration. Unquestionably, investors will realize that there's more risk involved with equities than they might have thought in the past, and hopefully will reallocate their portfolios accordingly.
Will we see some kind of impact, Ramesh, toward the end of the day today, or has most of the liquidation or redemption activity that we've seen already played itself out?
Well, I think there is some to come as investors understand that the only silver lining in their portfolio performance might be the fact that they have tax losses that they can realize. So that is likely to trigger some tax selling. There is no question that the tax sales will have an impact on the market as investors begin to digest the information.
All right, let me switch gears for a second to you, John, and I just mentioned redemptions. We've seen some record redemption levels in the past few months. Put some of those numbers in context for me.
We've seen about $48 billion in mutual fund redemptions in the month of September. If you count money market mutual funds, that takes it up to $63 billion. And the real whopper of a number is if you count redemptions and market decline together, we've seen the amount of money in American mutual funds go down by about $1 trillion in September. We don't have October numbers yet, but we expect them to be at least as bad.
So, John, when you look at the funds that have been able to weather the storm better than others, which ones have stood out as the strong and which have stood out as the weak?
You know, the decline has really been across the board this time, and mutual fund investors have suffered inordinately because usually their bond funds hold up, and this time they haven't because corporate bonds have done quite bad. The only place really to hide was in treasury bonds this time around. But if mutual fund investors are looking for a place to go, we think they should continue investing in their 401k plans in stock funds, and an index fund is always a great way to go. Most 401k plans have an index option, and one of the most distressing things we've heard at Morningstar lately is that ordinary working folks are not contributing now to their 401ks as a result, and that's absolutely the wrong thing to do. You should be contributing as much as possible now.
Ramesh, one of the things that people perhaps don't know enough about when you own a mutual fund is some of the tax obligations associated with either capital gains or capital losses that occur within that mutual fund. All of a sudden you get this notice and you're like, whoa! Mm-hmm. Explain exactly how that works, and when do we get that notice in the mail?
Indeed. You know, this is one of the less savory aspects of investing in mutual funds. Investors can control when they invest or disinvest, but the trading activity within the mutual funds themselves have tax consequences. Mutual funds tend not to be managed as tax efficiently as perhaps they could. As a result of this trading activity, there are frequently short-term capital gains, which are taxed at ordinary income rates for investors. That will give investors a double whammy in a market like this, because they may well have ordinary income they have to pay taxes on, and they have losses on their portfolio. You know, mutual funds typically generate these statements anywhere between 1 and 4 times a year, and that's an inescapable consequence of investing in mutual funds.
Okay, so what do we do to counteract that?
Not a lot that can be done to the extent that the mutual fund has realized either that ordinary income or those long-term capital gains. Then investors in the fund are actually stuck with those consequences.
But does it change somewhat if you have an index as opposed to a mutual fund that's driven by stocks? Because then every time you turn over an individual stock, it makes a difference.
Indeed. You know, I personally tend to be a big fan of passive investing, i.e. investing in the index directly or in index mutual funds.
John, just quickly as we wrap up here, we go to the end of the year. Where do you think we head for in 2009, knowing that Monday is the start of a new year for mutual funds?
You know, the great Peter Lynch always used to say that he didn't know where the next 1,000 points were going to be, up or down. And I think that's the attitude you have to take. But if you invest in stocks or stock mutual funds, stocks look cheap now going 3-5 years out. And that should be your time frame if you're investing in stocks or stock mutual funds. It's a good time to invest now. PE ratios are low.
They certainly are. All right, gentlemen, great pleasure having the two of you on. Thank you guys so much. Now let's go over to Jenna for a look at this morning's headlines. Jenna?